Ladies and gentlemen, live from Orlando, Florida, here at the beautiful Florida Hotel and Resort, we have a special presentation for you with Mr. J. Scott Shield on CMBS default and term outs. Please stand, give a big ovation for our special guest speaker here, J. Scott Shield.
Thank you, Ray. Thank you, everybody. Really appreciate it. You guys had a great few days so far? Yeah. Awesome. I really appreciate it. So many familiar faces in the audience, so many new faces. Ladies and gentlemen, what we're about to teach is something I've only taught once or twice over the course of the last decade. And so I want you to pay specific attention, but I also want to welcome our audience for our live stream. We're going to be going through something that I believe is going to be essential for you to not only understand, but to prepare for. What we're dealing with during this section is one of the major dominoes that I think is going to cause turmoil in a specific category and area of the overall commercial real estate marketplace. What we're really talking about, what we're thinking about here is CMBS default. Now, CMBS is a commercial mortgage-backed security. This is where different assets are financed and then they're packaged together based upon the quality of the credit, the likelihood of success for that developer in a way that gets sold off then into the secondary market and allows individuals to buy tranches of debt. We're going to get into this in great depth. So stick with us and take lots of notes. Thanks, everybody. CMBS, commercial mortgage-backed security, is a bundled investment. It's a bundled investment. You're not investing in a single asset, in a single area, but most often you are investing usually in specific, previously defined asset classes. Very frequently, you're only investing in one asset class, but they can bundle single-family homes with commercial assets, retail, hospitality, apartments, etc. It depends on what is underwritten in the tranche of debt that's being sold off into the secondary market. And that has to fit into a particular box. A bundled investment means that multiple mortgages on various properties are rolled into one singular investment vehicle and then marketed to investors. It's marketed to investors usually through Wall Street banks. Investment brokerage houses put them together and then they sell them. These investments are assembled and then are rated by various rating agencies based upon the quality of the properties as well as the details of the underlying loans that they're based on. These loans have a loan-to-value ratio, interest rates, maturity dates, specific types of assets, quality of tenancy, strength of guarantors and sponsorship, and then the location of the assets are then broken into Tier 1, Tier 2, and Tier 3 markets. So they're rated and they're scheduled. And we've got a video that we're going to play here in a few moments that I think is going to add a little bit of a humorous tone to a very, very, very serious topic. Once they're rated, they're sold off in layers called tranches, giving investors a stated return based upon the amount of risk that they're likely to encounter in this investment vehicle. They will continue to receive that income stream so long as those mortgages continue to perform. However, once even a small percentage of those mortgages begin to not perform or default, usually somewhere on either side of 5% depending on the risk rating, but oftentimes less than 5% in the overwhelming majority of investments, the debt then defaults and cannot perform and pay out the distributions. So the cash flows begin to falter. Because we are dealing with Class A properties in Tier 1 markets with excellent sponsorships, very few of these assets ever default during the term of the initial loan. Think of your brand new investments, your gleaming new shopping center, your beautiful high-rise office building in downtown Manhattan or Los Angeles or somewhere of that nature. Think of that beautiful hospitality overlooking the Pacific Ocean. Those assets, when sponsored by major corporations, right? Think of the ones that would build those types of facilities with great track records over a long period of time, pristine marketing network, unbelievable ability to attract tenants. In fact, in most instances, the tenants or the network are well established long before the shovel enters the ground. However, because not everyone rates that well, some of these assets potentially could default. But in the beginning, with things like Hilton properties overlooking the Pacific Ocean, high-rise office buildings with major Fortune 100 credit tenants in Manhattan, those brand new shopping centers that attract the top tier brands in the entire world, they'll almost always make it through that first set of CMBS debt. And most CMBS debt is usually pegged to a 10-year term. So for the first 10 years, the value remains constant. The leases are stable. The attraction to the marketplace is very high, and there are tremendous amounts of velocity in the absorption. We're dealing with top-tier credit, top-tier leases. The banks assemble these CMBS deals that they're making incredible amounts of money on. Their profits off of these are staggering. They package them up because they do the risk rating, and then subsequently they sell them off into the secondary market. But eventually what happened was the banks in the last crisis, in 2007, 2008, and 2009, during the meltdown, eventually ran out of the highest quality assets. You're only building so many sky towers in Manhattan. You're only building so many pristine apartment complexes on the shores of Miami South Beach. You're only looking at so many Hilton hotels that open every year. But the incentive to continue to package these CMBS deals up and sell them into the secondary market was just too compelling. The incentive, the profits that were being made. So eventually what happened was they would take the highest quality assets, and then they would begin to assemble tranches that would have a majority of the highest rated assets, and then they would fill out the tranches with only slightly less quality assets. But eventually, after they rounded these tranches out, more and more of the lesser grade mortgages started to infiltrate and find their way into these packaged commercial mortgage-backed securities. And these investments really started to change, both in nature and in performance. But the problem was that as even more of these lesser grade mortgages made it into the investments, the rating agencies still rated them incredibly highly because everyone was incentivized. Now, near the end, close to the collapse, the investments were seriously out of balance, filled with more of the lower rated mortgages called subprime mortgages than those top tier AAA credit rated investments that are in the top tier markets with excellent credit, excellent sponsorship, and excellent construction methodologies. Now, subprime mortgages do not meet the original investment criteria. However, the investors like the returns, the banks like the cash flow, so everyone was responsible for the problem. People knew that they were starting to invest in assets that no longer met the full standard, including the rating agencies, the regulatory commissions, the investors, the banks, the bankers, the brokers, the investment banking houses. This is what caused the financial crisis in the late 2000s. And some of those very same forces are at play today. It is incredibly important that you understand that many of the assets that we talk about, the third generation mobile home park that's selling at a 5 cap, the 30-year-old storage facility selling at a 6 cap, the 40-year-old industrial building with steel walls and block floors and lead paint, they simply don't meet the standard of Class A. But they're still being sold off in the secondary market. However, there's even a bigger issue at play. Because commercial mortgage-backed securities have usually a 10 to 15-year life cycle or maturity, meaning that they come due. And because these loans have long amortizations and very low interest rates, they are a good basis to develop new expensive assets. So they have low interest, they have long amortizations, usually 30 years. So they don't pay down much of the debt. They don't amortize a lot of the initial outstanding debt. And because they don't amortize that initial outstanding debt, once they reach maturity, they usually have a very significant outstanding balance. Now, if that asset absorbed properly, it's performing well, there's no problem. They just go get new debt, There's a new bundle that's put together, it's sold off in another tranche, and everybody's happy, and we move on. Think of like the Waldorf Astoria in New York City, right? The facility is 100 years old. It's been sold many times. Most recently, it transferred for over $2 billion. That's how these are supposed to work. They're supposed to be the standard bearers of the investment banking and mortgage industry. But when you start to put the other things into these tranches, it's a lot riskier. And people understand that they are investing in a CMBS tranche of, let's say, lesser assets like mobile home parks, storage facilities, and second or B tier industrial. Now, we already know that the trouble is happening in hospitality, retail, and central business district office, don't we? Right? Those assets that Class A that have that life cycle between 10 to 15 years on that debt, before the new development comes in and supersedes it in the mind of the marketplace. So you built the new one 10 or 15 years ago, but within 10 or 15 years, guess what's happening? All of the brokers, all of the retailers, all of the hospitality groups says, hey, we think we've got room to do this again. Why would they build yet another hotel in an area that did really well where they already have a presence? Because there's really only about 5 years left on that full 20-year property improvement plan. Once that 5 years runs, they could either rehabilitate the old one, or we could build a brand new one. You could rehab that one for, let's say, $50 million, or you could build a new one for $300 million. Much bigger tranche. Everyone gets paid a hell of a lot more. It's the new gleaming one. All the marketing, the media, it all goes out and everybody comes in. And you'll be willing to pay an extra couple $100 a night to stay in that hotel because of the status, and they know it. In addition to that, you don't want to shop at that old shopping center, you want to shop at the new one. Back then they did brass and glass and fountains. Today we do laser light shows and we have gold plated. We have marble floors, right? We have aromatherapy as you walk through the lobby. Crazy stuff, right? So they're always making it just a little better and a little more desirable. And then the tenants that were in the old place, as their leases term out, they shut down that location and they go to the new one. And everybody gets paid. The broker gets paid again. The tenant gets a brand new lease on life, brand new facility, brand new prototype, nothing out of pocket. They can be assured that the very best purchasers and buyers are going to go into that store with their black cards and their titanium cards, right? It's a way of just moving the shell here. And then once that tranche performs, we don't know what's going to happen with it. We're really not that concerned. It falls into Class B. And if it doesn't absorb, it falls into a Class C asset. Now, at the end of the cycle, whether another asset supersedes it in the mind of the marketplace or not, they've got a problem that they have to cope with. And maybe it's a little problem, meaning that it's easy to find new debt, or maybe it's a big problem, and that new debt is going to be either tougher to find or worse yet, maybe the asset, just before it came time for financing, didn't perform quite as well as it had in the past. Now, since the majority of these assets are not considered to be recourse loans, the developer or the real estate investment trust, i.e. REIT, has no underlying obligation to make the loan perform or even to keep the asset at the end of maturity unless it is a really well-performing asset. That's a big key here. They can walk away free and clear. They have no responsibility. So long as they didn't defraud the investors or the bank, they can just turn it over. Now let me go out there on the record and say that they don't want to do this. They would prefer to keep it performing. However, in most of these high-rise office buildings, hotels, these other assets such as, these retail shopping malls, the developer is only walking away from their equity at the end. But the assets likely performed quite well. Because in the beginning, when you're baking in the cost of the improvements, the tenant's rent is in the hundreds, in some cases even in the thousands of dollars per square foot per year. And it didn't cost that to build it. But because the amortization is so long, the cash flow is incredible. Now, at the end of that cycle, when they walk away from their equity, they're walking away from the developer equity. It cost them a certain amount to build it, but once they've got all those leases signed, or once they've got stabilized performance over a couple of years, they have the ability to finance that. So usually there's development debt, and then you go into the permanent debt. The permanent debt's where the CMBS comes in. And that's based on the value that's created. And 2 to 3 years in, the value is almost always significantly more than the developer had to construct. So they've gotten cash out. And CMBS does not always limit cash out. In many instances, they don't limit it at all. So the developer got paid, they got paid along the way. So at the end, yes, they're walking away from some perceived equity potentially, but for the most part, they can walk away and not truly be harmed. Now, because this ends up being the case, at the end of the loan, they can either keep the asset or they can let it go. If it's well performing, they'll keep it. If it's underperforming, let's let it go. They would have likely made their profit during the initial run with the high dollar lease-ups, the strong cash flows that were in place during the initial run of the asset. It is often easier for them to turn the asset back in at maturity, again, unless the asset is extremely well performing. And this is absolutely the case with second generation CMBS debt, right? So look, the first time the developer did it, awesome. No problem whatsoever, and they renewed the loan. But by the time we're talking about the asset in its 20th year of that life cycle, 2 10-year CMBS deals, well, almost certainly at that point in time, they're gonna be upside down. The COVID-19 pandemic and the governmental response has been a catalyst for these assets to become struggling assets, to accelerate them into their demise. States and Canada have performed the way that they were thought to have performed over the course of the last several years. Not many. How many retail shopping centers did well while people were forced to suffer stay-at-home orders, and people couldn't work, and restaurants were closed, and all of the, let's say, gathering facilities were shut down? Not very many. And more than that, how bad was the hospitality, travel, and leisure industry hit over the course of the last several years? Other than certain markets like Florida, maybe certain parts of Texas, almost every market has been literally devastated by these restrictions. That means that their performance is no longer in place. And all debt today is based on historic performance. The last 3 years of operating history, that's the gold standard. So if you don't have the 3 years of performance, it's very difficult to find new debt. Now, I have no doubt whatsoever that Congress, the Federal Reserve, and the banking laws are likely to experience some form of new legislation and modification. They almost certainly should. But right now, not so much as a peep out of Congress. That's troubling. And Congress had the opportunity to act, and specifically chose not to. Now, ladies and gentlemen, I want you to know, this is not only for us as investors to be warned about what may be coming with this huge tranche of debt that may not perform, that may not renew, and these assets that certainly would be devalued. It's also an opportunity for us to present that you may be able to find and cherry pick some excellent assets that you could work with. But last but certainly not least, this is a public service announcement for you to reach out to your congressional representatives to let them know that they must act so that we can prevent another financial meltdown. I don't care if we don't make $1 off of this. The point of it is we need to act before the first domino hits. If we do this, we can prevent another meltdown. Save ourselves trillions of dollars in losses. But if we don't act, these forces will absolutely come home to roost. Let me ask you a question. If the net operating income of an asset has declined by 30%, is it any possibility whatsoever that they're going to be able to replace their former debt at an even higher level? No way. And with the Federal Reserve promising and signaling that they're going to be raising interest rates over the course of the next 1 to 3 years, is there any chance that even more expensive debt will cause the loan to value ratios to be even lower still? Of course it will. Now here's the point. Once Once these assets get turned back into a lender, then the lenders evaluate the transaction and decide to send it to a special servicer. Before we get into that, I want to show you a little humorous clip that I think is going to give us the opportunity to add a little bit of levity to a very, very, very serious situation. How many of you have seen the movie The Big Short? That's based on exactly what happened in 2008. And we're going to talk about all of the forces that are at play, that were at play in 2008. And let me tell you a little secret. It's actually even more prominent today. Let's go and watch that clip.
30 days late, 60 days late. They paid on time. Michael scores. They caught him in their pants. About 30 days late. LTV 95, LTV 90. They caught up on their 60 days late. Jesus, what is that? LTV 110. I've never heard of that. 30 days late. They get the 7 rated judges. 90, 95. Jeez. Yes, it moved all day. He does this every few days. Hasn't spoken to me since he hired me. Maybe the LTV is high, like the
Michael, how are you, guy?
Lawrence, I found something really interesting.
Great, Michael. Whenever you find something interesting,
We all tend to make money. What's stopping you about it?
No stocks. I want to short the housing market.
really, but the housing market is rock solid.
Solid. Greenspan just said bubbles are regional, defaults are rare. Someone won't be there.
Say again?
Look,
Greenspan's wrong.
I don't think you mean to do this, but sometimes you sound very
Dismissive and superior.
superior.
It's a fact. Greenspan's wrong. I don't know how it's no longer.
Look, Michael, Metro Capital,
Back to 4 years ago when you were a doctor with a
dinky web page and some.
inheritance money, we've all done very well.
Why don't you just stick with stocks?
You know me. I look
For value wherever it can be found. And the fact is that these mortgage-backed securities are filled with
extremely risky subprime adjustable rate loans, and when the majority of the adjustable rates kick in 07, they will
begin to fail. And if they fail above 15%, the whole bond is worthless.
Michael, just take a beat. We'll talk about this later.
Lawrence, please don't patronize me. This
Mortgage-backed securities, subprime loans, tranches. It's pretty confusing, right? Does it make you feel bored or stupid? Well, it's supposed to. Wall Street loves to use confusing terms to make you think only they can do what they do. Or even better, for you just to leave them the fuck alone. So here's Margot Robbie in a bubble bath to explain.
Basically, Louis Rainieri's mortgage bonds were amazingly profitable for the big banks. They made billions and billions on their 2% fee they got for selling into these bonds. But then they started running out of mortgages to put in them. After all, there are only so many homes and so many people with good enough jobs to buy them, right? So the banks started filling these bonds with riskier and riskier mortgages. Thank you, Benji. That way, they can keep that profit machine churning, right? By the way, these risky mortgages are called subprime. So whenever you hear subprime, think shit. Our friend Michael Burry found out that these mortgage bonds that were supposedly 65% AAA were actually just mostly full of shit. So now he's going to short the bonds, which means to bet against. Got it? Good. Now fuck off.
It's only a matter of time before someone else sees this investment. We have to act now.
How do you know the bonds are worthless? Aren't they filled with fucking thousands of
Pages of mortgages?
I read them.
You read them?
Yeah.
No one reads them. Only the lawyers who put them together read them.
I don't think they even know what they've made. The housing market is propped up on these bad loans. It's a time bomb, and I want to short it.
Through what instrument, Michael? There are no insurance contracts or options for mortgage bonds. The bonds are too stable.
Lawrence,
This is what I'm gonna do. I am gonna get a bank to make me one. And then I'm gonna buy it.
Ladies and gentlemen, are we dealing with a superheated housing market? Seriously. Is it a superheated housing market? Supply chain disruption, labor costs, it's all skyrocketing. And at the end of the day, without question, people are bidding over ask every day to get their hands on an asset. When that happens, you have to recognize the peril. It doesn't go up unimpeded. It's not how the world works. And while interest rates are incredibly low, unbelievably low, and people aren't necessarily checking the credit like they should of the borrowers, well, the competition exists. But what has happened to our labor market? Our labor market's in the toilet. And you're eventually going to start to see the cost of inflation factoring in. Now, we're not even talking about the housing market, but it deserved a little glance. We're talking about the commercial investments that are put into the CMBS loans. Now, once assets are turned back into their lenders, they then evaluate the transaction and decide what they will do with it. And most oftentimes, they don't just immediately put it back on the market for sale. More often than not, they will send it off to a special servicer. The largest special services are L&R, C3, Aegon, CW Capital. Now, C3 is now Greystone. Okay? However, there are many others. These are where you can locate them online. Aegon AM, assetmanagement.com, cwcapital.com, greystone.com, and starwoodpropertytrust.com. This is where you'll be able to find and locate some resources to be able to put on a list to find out when assets are coming. But many of them liquidate through other sources. Many of the assets are marketed through larger brokerage houses, including C.B. Richard Ellis, Colliers, Cushman Wakefield, Marcus and Millichap, among others. They also go out to CMBS auction platforms, RCM1, Real Capital Markets, 10x.com, which is the commercial division of auction.com. In my career, I have bought assets from all of the larger special servicers, L&R, C3, CW, and Aegon. But can I tell you, over the last several years, it's been tougher. There's not as many assets out there. Now here's how this works. Here's an asset that I acquired. This was a defaulted CMBS asset. It was owned by a REIT. I'll tell you about that a little later, called Developers Diversified. They're one of the largest retail REITs in all of North America. They developed pretty much every Kmart and Sears that came out of the ground in the 70s and 80s. Mostly Kmarts. So this is the facility. Grocery anchored, discount dollar store, automotive, top tier fast food, banks, sit down casual dining. This is the overall facility. What you're looking at here is 531,000 square feet on 54 acres in a well-located marketplace. Built and developed in the late 80s and early 90s. It was developed by a private developer, sold off to the REIT at the height of the real estate market in 2006. It was sold for $44 million. It was developed for $80 million. They made their money over 20 years, then they sold, and they sold it at a nice number. This asset had all of the tenants that you would have wanted back in the day. Sam's Club, Office Max, Cinemark movie theater, department store. By the time we found it, it had already started to become obsolete. They had stopped maintaining it. They had stopped investing in the infrastructure. What happened was They lost Sam's Club as an anchor. They opened up a new store, like we talked about earlier. When Sam's opened the new store, this one had diminished sales, and they eventually closed it. But they were still on the lease for 2 more years, so the REIT held it while they were paying. The day they stopped paying, the REIT flipped the keys back to the lender, because it was non-recourse. They bled off the cash flow, and they walked away. What did that mean for the lender? The lender now has an asset that's in decline. When an asset goes into default, there's certain things that happen. One of which is that they don't have the ability to invest back in the asset. So take a look. Not a bad facility, not bad at all. This is the Burger King after it went dark. Sam's Club moved out, the theater shut down, Burger King didn't have traffic, their lease ended, they terminated. Friendly terminated. The bank closed. Office Max closed in a lot of locations. Baker Square, the regional breakfast spot, closed. We bought the asset and we rebuilt all of the infrastructure, and I'll get into this in a moment. I don't want to tie up this completely, but here's what we did. We started bidding on it. I'll show you, this is the work that we did to it. Completely redeveloped. All the infrastructure, all the underdrain, all the parking lots, all the concrete drive aprons, all the facade, all the signage. We re-tenanted it. Got a brand new grocery anchor, paying us as much or more with percentage rent in a brand new facility for 20 years. We relocated and positioned the commercial academy in the corner of the college. Here's the new site plan developed. Here's the renderings of the new facade. This work is actually underway right now. Once a special servicer has an asset, the underwriting laws and regulations that pertain to banks allow them to hold the asset for as long as 3 years. At the end of 3 years, they must dispose of the asset to rebalance their balance sheet. As you get closer to the end of that 3-year cycle, banks are far more motivated to dispose of the assets than they were in the beginning. When you can find an asset that was taken back a few years ago, this is key information for you to understand. Also, during the period of time known as the hold period, lenders are restricted on making major capital improvements in those assets. So when they find them and they take them back, they have to use them and they have to keep them and maintain them in the condition in which they were found. They're not allowed to invest good money after bad. The idea here is not only they're not allowed to make capital improvements, but in many cases, large portions of the tenant improvement allowance that aid in leasing are forbidden. This means that an additional investor funds are needed to improve the value in the asset are restricted. The bank can't throw that good money after bad, even though investing in it and cleaning it up would yield a much higher recovery. They don't know, the regulators, that they can trust the bank's judgment to steward the asset out of the default. So they simply restrict them from doing it. Now, you would think that the individuals or the banks and the special servicers that hold these assets would say, well then, we need to clean this up and get it on the market as quickly and as inexpensively as possible. But that's typically not what happens. They bleed off the cash flow even further, allowing the lease terms to burn down so that they can use that capital as recovery. And they put it out to the management firms. Now, in some special instances, they do have the ability to go ahead and acquire new monies to improve the asset, but very rarely. Bloomberg and Trepp release reports of soon-to-be defaulted CMBS assets that we'll be able to track on a monthly basis. We'll be able to do this and we'll be in a primary position to make offers when the assets eventually come back on the market. We were aware that the Willoughby Hills CMBS default was happening 2 years before it actually came on the market. And it didn't close for an additional 2 years. That's how long it took. It was a defaulted REIT, an asset from a group called DDR, Developers Diversified Realty, who eventually became Site. Now, a portion of these reports are available to us, and then therefore to you, the Commercial Academy membership, on a routine basis. Without this service, the average cost to get this list would run you about $2,000 a month. How many of you would be interested in getting access to this list? I think so. Let me tell you right now, that asset that we attracted, that we found, that sold for $44 million, that was developed for $80 million in the 80s, we acquired it. I didn't acquire it on my initial bid. My initial bid was $7,250,000, which was a fraction of what it had just sold for. However, I wasn't the high bidder. Someone outbid me. They then came back to us. They came back to me and they said, listen, you're up. The previous buyer wasn't able to proceed with the transaction. So we went through our due diligence and we found that there was a particular tenant in there that wasn't performing at the level that they were supposed to be. They weren't opening every day. They were in violation of their continuous operating covenant. And so not only did we not pay the $7,250,000 that we had originally offered and struck the contract on, but they asked us what type of discount we would want. I spoke to my counsel and I said, well, with this type of a lease, I think you should ask for $250,000 in discount. They were at the end of their 3-year cycle. We knew 2 years before they got it, it was coming. 2 years later, they still hadn't fully marketed it. And I went back to them and I said, we're willing to offer you $4,800,000. And they accepted it.
Oh my God.
I bought the asset for 10 cents on the dollar. It had the performance that it needed. It was only 29% occupied. We used the strategies of subdivision, re-tenanting to own over 70% of the asset free and clear. The asset was stabilized in under a year, and at just one portion of it, only 200,000 square feet of the 531,000 square feet, just recently appraised for $15 million, and it still has 30% to be filled in that one space. We're negotiating with national credit tenants. We took that former bank and we moved in a police substation that the community absolutely loves. We've got absolute top tier, first rated credit tenants that are interested in coming back. And we saved a community that would have otherwise been blighted. And we got paid handsomely in the process. We're doing good work here, ladies and gentlemen. We're doing things that are changing lives, changing communities, and making a tremendous profit while doing so. Over the course of the next several years, there's going to be a tremendous number of these assets that are coming. Certainly not the entire marketplace, not everything. But it is incumbent upon us to get out there and take a look to find these assets. And when you do, if you can't handle them, be sure to contact the Commercial Academy. If you like these and other strategies, please like and follow us on social media, or better yet, get to an